Welcome to the Real Estate Players Podcast. I'm Joe Pizzurro with Break Chain Capital Investments.
And I'm James Wilson with Old Capital Lending. And today we have a special guest, James Zhang,
How's it going, guys?
also with Old Capital.
Thanks for having me.
Thanks for being here.
Yeah.
How's your Friday?
Yeah, no, definitely great to get out of the heat. So appreciate you guys having me in the studio.
Yeah, this is going to be a show basically talking to people in the real estate industry, doing deals. And we just love to get your feedback on what's going on. We work with loans a lot, so interest rates is a big topic. Everyone wants to know what's going on with interest rates. And so, yeah, I guess what are your thoughts on the recent news?
Yeah, I mean, earlier this summer, I had a webinar that I titled Fear. And a lot of people sort of got scared. But then once you peeled back the layer, it was a quote regarding like sort of fear is your friend. So a lot of institutional equity is starting to come back to the market. And I haven't done my webinar for this month, but I think it's going to be something like Road to Recovery. So a lot of people feel like, the last 2 years have been pretty challenging. Values are down anywhere from 20 to 30% from the peak. And so, a lot of people, they put 75, 80% leverage on these deals. And so a lot of equity's been wiped out if you sell right now. And there are some sales happening right now where guys, whether it's an interest rate cap or a maturity that they just can't figure out and they're having to go right now, they're losing equity. And so on a lot of deals, we're trying to sort of get people to, 2025. I mean, I can't remember when
Survive
I said
to 25.
Yeah.
I don't know when we said that, survive to 25, or where we adapted that from, but it was something like,
I think it was in Vegas.
yeah, in Vegas, like at NMAC. What year though? Like
2023.
23? Okay.
Beginning.
Yeah. Beginning of 23, we're like, hey, you just need to survive to 25. And I think I read an article that was sort of about the early 90s. And it was similar time, like, the Tax Reform Act came through, the RTC came through, and people in like the early 90s, it was like very painful because a lot of these deals got foreclosed and people, there wasn't a lot of transactions.
Is that
And
why you don't see a lot of
so
90s
it
deals?
survived. Yeah. So yeah, there's no new construction in the early 90s because there was no financing to do new construction. And so a lot of brokers, like the motto was like survive to 95. And so that's why that's
History
sort of
repeats.
yeah. So that's why it was, that's why when it was sort of like, okay, we did a lot of bridge loans in 21, 22, and those maturities are coming up in 24 and 25. And so sort of like survive to 25 to get to that point. And so that's
what was the story after? Was it a
95, 96? Yeah, I mean, it was
Started
pretty
picking
much a
back
good,
up?
yeah, it was a run all the way probably up until sort of the .com, sort of 2001, September 11th timeframe. So like sort of mid 90s, it was you were back and it was, 3-4% growth every year, just like clockwork until, tech stuff just sort of got crazy and all these companies were going to the sky that had no profit. So, that game only lasts for so long, I guess, and people at some point need to get paid back. So
it seems like we bottomed out a little bit, and then we might have a good 5 to 6, 7 year run ahead of us. And
yeah, I
then
mean,
2030, who knows?
yeah, I mean, I think everybody's sort of seeing the same things. Is that if let's say in Dallas right now, there's 30 or 40,000 units being delivered, so there's a lot of supply, maybe 3 to 4% of the inventory in DFW. In Austin, it's definitely heavier. It's probably 30 to 40,000 units, but that's 10% of the supply, so almost double. And so, but all that pretty much is going to shut off, hopefully by the end of next year, right? So when people couldn't buy value add deals in 21 and 22, they just said, well, I'll just go build it. And there was plenty of money for construction loans on floating rate construction loans. And so all that stuff is delivering this year and next year. So it takes about 2.5, 3 years to build it, lease it up. And so that's why we're seeing a lot of concessions hit the market right now. And so, new deals, like my sister just signed a lease in Austin and she got, 2 months free on a 12-month lease. And,
Wow.
in Dallas, they're starting to do the same thing. You're starting to get, 500. A class,
Yeah.
but then so it's what's happening is that in the A class, let's say they're giving 2 months free, and so your effective rent maybe or your market rent might be $1,800 for one bed, but then with the 2 months free, now it's really like 1,500, and your B class stuff is right around that number, and so B class starts having to give 1,000 off, and then that slides into your C class, and now your C class has to 250 to 500, even on the lower price points. So we're seeing sort of more concessions across all classes right now, just depending on people's occupancy, right? Like if you're 95 and you've got 2 or 3 units and you're not worried about them, and you have good renewal rates and stuff like that, then people aren't giving concessions. But we're seeing at properties that are in the low 90s, high 80s, they're giving concessions to stay above 90.
You mentioned values are down 20-30% from the peak. Do you feel that's a true discount or where they should probably be anyway?
Well, I mean,
Was it artificial peak?
yeah, I mean, it all depends on sort of the spread between, like, if you look back at sort of cap rates and your all-in interest rate, there was always like 150 basis point spread between, all right, you're buying, like when I started, you sort of bought a 7 cap and your debt was 5.5. And so you always had about 150
Okay.
basis point spread. And then just in the last 2 years, just because rates have come up so fast on the federal funds and even the 10-year.
There's no gap.
Yeah, they're essentially like those intersected probably 2020 into 22 or something, when the Fed raised the rates so fast and 10-year came up so fast. And those pretty much have been at the same level. And so you're having to accept negative leverage the last 2 years. And so that's what's really caused values to drop, especially when not everybody's back into the market. Like a lot of these larger institutional guys, they're buying these deals all cash. Like they don't even need to put debt, or they're putting very little debt on it. But for a normal, syndicator who's, doing a deal by deal, they have to put 5-6% debt on these deals. So to have a cap rate at 4.5 or 5 just doesn't make sense. You can't raise money, and you can't give any cash flow to your investors.
Yeah.
What do new acquisitions look like? Are people hungry for deals right now? Like interest rates, around 5.5%, 5%?
Yeah,
on
I
agency.
think.
Like what kind of leverage are we getting?
Yeah, I think on A stuff, the key word is basis play.
Basis
So
play. Yep.
basis play in terms
the
of
buzzword.
Yeah, that's the basis. So there's no cash when you see the word basis play, that means no cash flow. So on A stuff, if it costs you, let's say $250 a unit to build right now and all in, and then you can buy it for $200, it feels good,
Yeah.
right? But then a lot of those deals, they're still trading at, let's say, 5 plus or minus 25 basis points, right? And so your debt, you can maybe get at 5.5 to with 10-year down, it helps, but so you're maybe 5 to 5.5. And so you're sort of right at that sort of neutral leverage point. And then, I mean, so a lot of people what they're doing is they're just putting less debt. So instead of getting 80% leverage, which, agencies won't give you anyways, because they're not qualifying on 125. On A stuff, we're seeing probably 55 to 60. And then B stuff, you're probably getting closer to 65 to 70. And C stuff, you're hoping to get 75 to 80. And so that leverage is helping because equity's hard.
Yeah. And what about bridge loans? Are those still around? Are people
Bridge
still doing
loans-
those? Or is
bridge
that a
loans-
dirty word in industry?
Bridge loans are still, what's funny is like, everyone who does the opposite, right? So if you were in 21 and you were doing a fixed rate Fannie or Freddie deal, it was the opposite of everybody else, but you look like a genius right now. And everyone doing a bridge loan right now might look like a genius like 2 years from now, because they flip out of the deal and they have like a 1% penalty. But bridge loan is, it's still a very challenging environment for bridge loans. We see a lot of people, at the peak, we maybe had like 20-30 people who could do a bridge loan in terms of number of lenders out there. Right now, I would say that's probably closer to 5 to 10 in reality.
Wow.
But I mean, for a moment there, it went to 0, right? So towards the end of 22, going to 23, everybody just disappeared on the bridge loan space, and pretty much all of 23, you were pretty much just doing agency. You're doing agency acquisitions, agency refis. But this year, I would say um, the the hottest money is probably CMBS, right? So it's not the bridge is still there, but nobody really wants to take on SOFR plus 3.5 money right now, especially if you're buying on a 5 or 6 cap. I mean, it's expensive, real
So
expensive.
what's the draw for CMBS? Why CMBS over agency?
Yeah, so CMBS, I mean, we didn't even talk about my background before we started, but like CMBS, so I was an underwriter for CMBS for like 10 years.
Yeah.
And so CMBS is a little bit wider than agency. So agency is specific to multifamily or residential housing, and CMBS is all the product types. So you're looking industrial, office, retail, multi, student housing, hotels, everything on the commercial space. And it's really the only place that a lot of other property types can go to get non-recourse, fixed rate, and longer term loans. Almost everywhere, like if you're doing a retail center or a self-storage center, you can get money from the bank, but it's recourse and it's typically only 3 to 5 years. And so people come to CMBS because they want 10-year money or 5-year money, and they want it fixed rate and non-recourse. And so CMBS has become hot now. Number one, because there's more people looking for sort of capital to invest, and so that's what spurred a lot of the bridge loans, is that people were looking at their savings account and it was 0.01% in terms of your interest, and so to get 5 or 4 on a bridge loan or a CLO was great, right? It was backed by real estate and everything. But the same thing's happening in the CMBS, right? There's a lot more players in that market, and for people who need a little bit extra leverage, or they need the borrower maybe has some I don't know what to call it, just some challenges, whether it's lawsuits, foreclosures, give backs. It can be an issue with the property where agency just won't do it. Maybe there's been a bunch of crime on the property, or just that area is pre-review, and so the agency's like, look, I need a 135, 65%, that's or 55%. I just can't do any more leverage. So whenever there's a challenge going to agency, because agency right now is, let's say, 5.5%. You can go to CMBS and they can give you higher leverage. They can maybe use a lower debt service coverage, but your rate's probably going to be 100 to 150 basis points higher. So as long as you're willing to accept that, and like CMBS is still cheaper than bridge, and so a lot of people are just going to CMBS.
So interest rates. Did you bring your crystal ball?
I think I feel like everyone moves, data dependent based off of where the latest report comes in. But I feel like there's a general sentiment shift that it's pretty much Fed funds is definitely going to be lower. The question is, how much lower does the 10-year go? So, I mean, most people are counting on, maybe 50 to 75 basis points this year off the federal funds rate. And so you're, 4.5 by the end of the year, and then maybe another 75 to 100 after that. So you're 3.5, which feels pretty good. But the 10-year is the challenge, right? So whether or not it's sort of a hard landing. So if it's a hard landing and unemployment, starts jumping by, a percentage point every month, then 10-year is going to come down pretty fast.
Do you feel like it's already baked in? What I'm hearing sometimes is
it's already baked into the market.
Yeah.
Sure. Yeah. I mean, I think right now where we sit right now is probably around 3.75 to 4, just depending on what day it is. And I think that bakes in probably more of a soft landing.
Okay.
And so, but if you hit the hard landing button and it's unemployment goes to 5, 6, 7, 8%, or there's just more layoffs, like just in the past, we've heard layoffs at more tech companies and things like that. Those people haven't sort of trickled through the unemployment system and all that, and that's going to be where it's going to be a little bit more challenging. So I think what's important for real estate investors is that, yes, lower interest rates are good for you. You pay less interest, but the reason the interest rates are going down is that the economy is softening, and there's a potential for a tougher or higher chance of recession. And so your tenants who are paying,
Living paycheck to paycheck.
yeah, living paycheck to paycheck, that delinquency is going to go up.
Yeah.
And so, I
And
probably,
credit card debt's up.
yeah, so I think when I was interviewing Jeremy, the one thing he said to me probably like 9 months ago or even a year ago, he was like, your NOI a year from now might be lower than it is today. And I was like, no way, there's no way my NOI, and nobody ever thinks like, I've never seen a pro forma where the
NOI
NOI is
went down.
lower year over year. Like I
Yeah.
haven't seen one pro forma ever that way. And so that's one of the things you have to balance right now is that, let's say you're on a bridge or you're even on a floater, like a Fannie or Freddie floater, and you're deciding, okay, do I go to fixed rate now or do I wait? Interest rates might come down. Is that your NOI is sort of set right now. Let's say at $1 million, and a year from now it might be 950 or 900. So even though interest rates come down, you might not necessarily qualify for a bigger loan a year from now, depending on, obviously your occupancy and concessions and your overall expense load. So that's does that answer your question on interest rates?
I think that's pretty good.
Yeah.
Let's talk about bank loans.
Yeah.
So bank loans typically go off the prime rate, right?
Prime, which is 8.5 right now.
8.5%.
Yeah.
Are you seeing any bank loans getting done, or people looking at those?
So I think it's a combination of if for some reason the property doesn't qualify agency, so let's say it's 80% or 75%, or it's just too small, right? So if it's under $1 million or even under $2 million, it sort of gets expensive on Fannie and Freddie. And a lot of the sellers and buyers who are buying like $2 or $3 million properties, the onerous process of paperwork that Fannie and Freddie, like the joke we had was pretty much like they want to take the blood of like every tenant to make sure that they're in place.
Well, I think someone said they're requiring pictures of the tenants now. Is that
Yeah,
true?
so I mean, I understand. It's Howard Marks is one of my guys that I follow, and the pendulum sort of analogy is very similar in lending. So the market, it doesn't just like ever just sort of go from super hot to warm to cool. It just like swings, and all of a sudden like nobody wants that product, right? Same thing on underwriting, right? Like it was super loose in sort of 21, 22. People were like, just okay, if you can't get it done in 30 days, I got a guy 10 guys behind you. Yeah. Right. And so underwriting just got looser and looser and looser. And now sort of agencies, the only guy in town, along with CMBS. Now people are like, well, I want to 100% make sure that everything that is on the rent roll reflects reality. And so that's why they're going to extreme situations, which, I mean, I understand. I mean, at GE, we would used to, we called it like a NOI audit, where we would basically pay somebody to go through all the bank statements of the seller or the borrower if it was a refi, and check off every tenant's payment and made sure it tied out to the bank statements.
Oh wow.
And on office retail stuff like that, you only have like 5 tenants, so you should see like 5 tenant rent payments. Like multifamily was a little bit
unit
property, with multi, it was more of a high level, like, okay, so we look at the rent roll and we look at T12 and we're seeing 300,000 come in income that you're reporting, and then the bank statement should have 300,000 plus or minus like 5%, right?
Yeah.
And so if we didn't see that on the bank statements, and sometimes sellers would be like, I'm not giving you my bank statement. And it's like, okay, well, we're not doing the loan. Right. And so, yeah, so you had to, it's one of those things that you don't think about checking, but then, whenever you buy a deal at 10 million and you sell for 15, nobody cares. But when you buy the deal at 15 and then you get in there and you didn't do that audit, and then all of a sudden you check, you walk all the units and you find out like it was like the seller's mom on the lease or the seller's brother, and like they're leaving, they're already gone,
Yeah.
right? And just crazy stories of like people just falsifying rent rolls and income statements and just to get a higher price, and buyers are sort of left holding the bag on it.
You seen any other agency restrictions, any specifics that have come down recently?
I mean, I think the main thing on agency is that it's going to take a little bit longer
To get the deal done?
to get the deal done, and sellers are going to have to be more patient, buyers are going to have to be more patient, and the challenge is that it's the best deal, in terms of interest rate, in terms of non-recourse, IO amortization. So it's you got to have patience, and you've got to, and to me, like, I've worked with some borrowers, and literally I'll send them a checklist, and then the next day in the Dropbox, numbered, labeled, is every item, right? So it's like just being diligent about like that process, and it really isn't too challenging. It's just if you're not organized on the front end, and you're just sort of, as a GP, you're doing a lot of things, right? You're doing the loan, you're doing the equity, you're dealing with the attorneys, you're dealing with the seller, you're talking to investors. There's a lot of stuff going on, and so just making sure that on the lending side, you're getting all the due
All the
diligence
ducks are in a row.
all the ducks in a row, and just have someone on your team who's sort of done a couple loans, because you just want to see around corners quicker so that you can react faster.
What percentage of bridge loans would you say are in trouble? Is it a pretty big percentage?
So right now, what we're seeing is majority of lenders. So whenever you do a bridge loan, it's usually a 3-year loan term and then 2 1-year extensions. So pretty much everyone who bought a deal in 21, they're hitting that maturity right now, and they're having to go back to the lender and ask for an extension. And a lot of those deals in the extension, it said, all right, you got to pay me an extension fee. You got to buy a new rate cap, and I want a 125 debt service coverage. And so everybody's
usually want like a debt yield of
yeah.
7.5
So yeah,
or-
so the 125 debt service coverage is, they can use whatever interest rate. Usually they use like sort of market rate, right? So whatever Fannie and Freddie are charging, and they want a 125, and that might correspond to like 8 or 9 debt yield, depending on where the interest rates are today. And most people, if they had that, they would have already done a refi to agency, right? And so nobody qualifies for the extension based off of that. And so in the documents, it says, yeah, you need to pay down the loan to get to that point. And nobody's got the money. And so all these lenders essentially right now are just saying, okay, we're going to give you another year. So this big reckoning that we thought was going to happen this year hasn't happened, because a lot of these guys have just gone back to the lender and said, hey, we need 12 more months, and they've bought the interest rate cap. The guys who have sold are the guys who, let's say they bought a $30 million deal, and now they need an extension fee of 0.5% of the loan, and they need to buy an interest rate cap, which is usually about 3% of the loan amount. So now you've got it on a $30 million loan, you've got to come up with, I don't know, $1 million. And so if you don't have that at the property level, or the general partners don't have that money, those deals are going to sell right now. And so that's what you're seeing in terms of distress on the bridge loan side, is people willing to go right now. But then let's say you did that $30 million loan and your property is worth 25. You can't even go.
Yeah.
You can't even sell
Equity's
because
gone. You got to put money in.
Yeah. You as the seller, you're bringing $5 million
to the table.
to the table. And so that's not going to happen.
Yeah.
And so you're in sort of workout mode with lenders. Number one, for extensions, which depending on where the value of the property is, that's what's happening. But then as a borrower, you're still having to come up with that 1-year interest rate cap, which is 2 to 3% of the loan amount, because people still think the federal funds is going to be, probably high 4s in 12 months from now. And so that you basically are just prepaying all the interest, right? And so, that's usually 2 to 3% of the loan amount. So you got to come up with that money.
So any properties that, let's say they qualify for the debt hurdle and then they want to extend, but are you seeing the lenders ever just say, no, we just want to call the note due? Or
No, most lenders. So when I was a G,
Or
like we don't actually want the property. Most lenders
Yeah.
don't want the property.
it's a head fake.
Yeah, it just is the only time we've seen where lenders want the property is when you stop making the payment. So if you stop making the payment, like in this last quarter, Arbor has about $1 billion that they ain't making the payment.
Wow.
And so, they had to cut deals with those people and just say, look, I know you can't pay us 9. How about you just pay us like 6? Can you pay us 6? Yeah, I think we can pay you 6. And then we're just going to accrue the 3%. And then you pay us at the end when you refi and maybe rates come down. And so you're seeing all these deals being cut.
Just kind of workouts.
Yeah, you're having to work out. And then, I mean, the people on the call were like, so this $1 billion, like how much are you gonna have to like actually foreclose? And he was like, probably a third. So 30% of this stuff, we're gonna, these guys just ain't gonna make it, and we're gonna have to foreclose. And then so you're gonna start seeing lenders take back properties, and that's probably the part of the cycle that everybody sort of wants to get through, but it like takes a long time. Right. So you'll see like in the Real Deal or BizNow, like all these properties posted for foreclosure. Then you go to the foreclosure, at Dallas County, and you're waiting for something to happen. Nothing happens because they catch it up. And then the next month, it's posted again and it's posted again. So it's just this constant, like, that's the lender's last resort is, all right, you're not paying me, posting up for foreclosure. And then we'll see what happens, right? Once these lenders start taking back the properties, we're seeing some lenders they'll take back the property and they don't have anybody in Amarillo or some of these other smaller cities. So they're just like, just sell this thing. So we're seeing brokers come out, and instead of it saying value add, it says lender owned, REO. And so that's getting people to just sort of wake up and say, all right, like maybe I'll take a look at this deal, because at least the basis is the loan amount for the lender, and they might take a discount to that.
Cool.
So one more question we got time for. Tell us about the Old Capital Conference.
Old Capital Conference. So we started the Old Capital Conference in 2017, and it was really just a way we interact with so many different people in the industry, whether it's brokers, other lenders, property managers, GPs, LPs. And we just sort of hosted it in Addison, and it was maybe 200 or 300 people the first year, and people liked it, and we're like, all right, we'll do it again. And then we just sort of kept trying to raise the bar every year. So some years we've had it at House of Blues, we've had it at AT&T Stadium, we've had it where the Rangers play, so all the different ballparks. And this year we're having it at the Bush Presidential Center library near SMU. And we thought since it was an election year, it'd be fun to try a different venue. And that place is almost as quiet as the studio. Like it is,
Wow.
It feels very, I mean, obviously when you have 400 real estate guys in there, it's not gonna be as quiet, but it just has a very distinguished, like
very distinguished.
Yeah,
is a good word.
You're almost like in the White House. I don't know. I've never been in the White House, but close to that. And so it's just really a place for, I mean, I don't know how many stories that people have told me of, coming to that event, meeting other GPs, LPs that they go on to invest with or work with, brokers, meeting GPs that, a lot of times everybody's like, all the brokers are trying to call GP never call them, and vice versa, right? So like when a GP has 20 deals, he doesn't pick up the phone, and then when GP has 0 deals, he's calling all the brokers, right? So it's just this weird. And then at this event, they're right there, right? So the brokers talking on the panel,
see everyone.
Everybody's there. And so especially I would say in the Dallas market, if you're coming in, if you're trying to get into the market, or you've been in the market, and just you sort of meet all the players in one spot. And
the first night is like 4 or 5 hours of just like going to the bar and hanging
Yeah,
out.
so the first
just networking.
So the first couple years in 17, the first year we didn't. I think it was even in maybe 2017 and 18. We just had it as a 1-day conference, and then in 2019 we were like, oh, maybe we'll just try to do something a little bit beforehand. People were like setting up happy hours or whatever, informally, and we were like, oh, we'll just tell everybody the same spot. And then we had it was raining, it was like a thunderstorm, it was like complete nightmare parking, and we still had 300 people like stuffed into like a bar near American Airlines Center. And we were like, okay, And then so like everybody was there for like 4 or 5 hours. So then the day of the event, people were actually like listening to the panels, right? Instead of like in the first couple years, everyone's outside like just trying to network and
They're just
yeah,
tired.
yeah. So so we've added the happy hour piece. So this year it's in Addison at Ida Claire, and we just rent out the whole venue, and so it'll just be us in there, and then we'll have the happy hour and then the full day event at the Bush Library. So
Very
yeah.
nice. Why don't you tell our viewers how they get a hold of you and what you can do to help them out?
Yeah, I mean, so most people, the easiest way, you can just email me. So you can go to Old Capital website, find my email there, or it's just jeng@oldcapitallending.com. And then if you just want to like hear me more, you just go on YouTube, type in James Zhang, and there's, I don't know, hundreds of hours of webinars and everything about financing and investing that I could think of, and that's probably the two best ways. And yeah, I mean, people reach out to me for probably like two or three things. One is if you're looking at an acquisition or refinance and you just want a quote on a loan, we do that. If you're just looking at getting in the Dallas market and have questions about a submarket or a new deal, we can definitely get you information on that. We have a lot of data sources that pretty much when we talk to somebody for like 5 minutes, we can tell them the whole deal, right? Because we probably have financed the deal. We've seen the deal 3 or 4 times. And the third way is, I mean, I invest in a lot of deals as an LP. So some people will just like ask me, hey, what do you think of this deal? And so that's probably the three main reasons people reach out. And so, yeah, that's probably the best.
Well, great. Well, thanks for coming out.
Yeah,
And
thanks for having me.
that's today's show, and we'll catch you on the next episode.
Thanks for watching.